Let's finish up the income approach with Chapter 14. This is income capitalization rates and techniques. We have several different learning outcomes for this chapter, so we're going to look at what income capitalization is. We're going to look at the 3 characteristics of a future stream of income. We're going to list the 3 methods used to derive or to calculate interest or capitalization rates. We're going to define and illustrate direct capitalization, and we're also going to look at discounted cash flows. Actually, no, we're not. We're not going to do discounted cash flows in this chapter. Income capitalization is really all about the time value of money. Now, we know that a future dollar is worth less than a dollar today. Capitalization reflects the time value of the dollar by discounting or reducing the expected future income to its present value. Now, I know most of you have done this in your finance classes already, so a lot of the terminology that we're going to look at in this chapter should look familiar to you. Here we have the definition of income capitalization. And really, it's just the process of converting income estimates into an estimate of value. So, what are we going to make in the future, and how are we going to translate that into a dollar amount today? Now, there's several different income characteristics. We have the quality, the quantity, and the duration of the income, and all of these are going to matter. The first one is going to be the quality. This is the relative risk of the investment. So the less risky, the better. And then we have quantity. This is the amount of expected future income or cash flow. How much are you expecting every single year? How long are you going to hold this asset? Is it for 5 years? Then over a 5-year time frame. What is the expected income that you think you're going to receive? What does the cash flow look like? And then we have duration. What is the timing and the expected frequency and duration of the income? How often are we going to see money coming in? How long is that going to happen? Now, it's going to depend on what kind of asset we're talking about. If it's an apartment complex, you're going to see income coming in every single month. If it's a retail space, a retail store, okay, and maybe you're estimating what the value for that retail store is, then you're going to have cash flow every single day. So these are some of the income characteristics that are important. And here again, we just have the 3 aspects of future income: the quality of the income, the quantity of the income, and the duration of it. I've already talked about the fact that capitalization recognizes the time value of money. It estimates the present worth of future benefits, and we do that with a cap rate. A cap rate is any rate that is going to be used to convert income into value. Now, the capitalization rate provides 2 different things. You have a return on your investment, and then we have a return of the investment. A return on the investment is the interest or the yield that you receive. Return of the investment is the initial investment amount that's returned whenever you sell the asset. So this is also referred to as capital recovery. As an appraiser, you really should consider the investment criteria that motivates purchases, because real estate competes not only with other real estate properties, but also with other financial investments. And so you need to consider, from an investor's perspective, what is the investment criteria of certain things. And when you look at these different criteria, that might determine whether or not you're going to invest in real estate or whether you're going to invest in something else. So some of the investment criteria are listed here. We have safety. How reliable is the income? We have the yield. What do you anticipate that you can make off of this property when you sell it? How liquid is the asset? You know, when we talk about real estate is not considered to be very liquid. Liquidity refers to how quickly can you turn this into cash. And even if you listed a house today, it would still take you, even if you got an offer on day 1, it would still take 30 to 45 days to close the loan. Now, if you do have someone that's paying cash, it would take about a week, but that's very unusual. So the liquidity of real estate property is not that great. Now, when we talk about something like stocks and bonds, they're very liquid. You can sell them very quickly. So there's a big difference there. We also have management and we have appreciation. So how much could the property appreciate in value? We have to consider things like burden of taxes, though. It could be that you could have a shelter from taxes given whatever kind of asset it is that you're considering investing in. Denomination refers to smaller investment properties being more appealing because you're not investing quite as much on the onset. Hypothecation refers to using property to secure debt, and really that goes hand in hand with leverage. The more properties that you have, the more leverage that you have, the more equity that you have in the properties that you own. That also too gives you more leverage so that you can buy more. We also want to look at the current and future returns. So what is the income stream that you're expecting to see on this property? What does the cash flow look like? Now keep in mind the cash flow is earnings after you pay any principal and interest on your mortgage payment. So we also want to look at things like reversion, resale proceeds. If you resell the property, are you going to be able to get all of your money back out, and how much will you make? How much has it appreciated so that you can make money? So we're going to look at yield versus recapture. Yield is the return on the investment capital, and then recapture is going to be the return of the investment capital. So I mentioned that in the previous slide, and they're just sort of reiterating it here. So the question here is which property is the safer investment? So it looks like at the top we have a burger joint that no one's ever heard of before, and then underneath that we have a McDonald's. Which one is a safer investment? Well, that's a pretty simple question, right? Because McDonald's has a proven business model. They know exactly if they put it in a certain location that has a certain number of traffic count that's going to go by that McDonald's every single day. They have a really good idea of how much money they're going to make. So you're not reinventing the wheel with a brand new hamburger joint. Now it could be that number one up here has better burgers. In fact, they probably do, right? But everyone knows when they go to a McDonald's what to expect. You know what you're getting. You're getting an average burger, right? Not the highest quality in the world, but no matter which McDonald's you go to, whether it's in Georgia or Texas or Hawaii, you're pretty much getting the same thing. It is a proven business model. So if you were to go to a bank and say, I want to invest in this burger joint that no one's ever heard of, or I would like to invest in a McDonald's, which is going to be a safer investment? McDonald's every time. Here we're looking at specific income procedures and how they relate to the economic principles that we've discussed in this class. Now, techniques of income capitalization are derived from these economic principles. So let's see how each procedure relates to the principles that we've discussed. So first we have projecting income for the property. If we're trying to figure out what the income for the property is going to be, that is going to be the economic principle of anticipation. When we're subtracting our operating expenses, that has to do with the agents of production. Remember, the agents of production are labor, capital, management, and land. The value of each of the agents of production is proportional to that portion of the total income that it contributes to, right? So when we're talking about operating expenses, we are looking at agents of production. When we're allocating net income to land and buildings, that also is going to refer to agents of production and also the principle of contribution. How much does the land contribute to value? How much do the buildings contribute to value? We also have valuing land by the residual income attributed to the land. This relates not only to contribution, how much does the land contribute to value, but also highest and best use. Remember, we always look at a property as if it is vacant, and we ask ourselves, is this property used at its highest potential? If the answer is yes, then we move on. If it's not, then it could be that we could change whatever it is about that property, we could change the use of it so that the highest and best use would be obtained. Here we have an overview of the economic principles. The first one is the principle of anticipation. We have the principle of the agents of production. We have the principle of contribution and the principle of highest and best use. So let's go over each of these again just to make sure we understand exactly what they mean. So here we have the principle of anticipation. We know that markets anticipate what the future benefit of ownership is going to bring. Value is equal to the present worth of future benefits, and income capitalization discounts future income to a present worth. This slide is an illustration of the agents of production. So we know that the agents of production are labor, capital, management, and land, right? All of the agents of production are always paid first, and then whatever is left over is going to be your income. So as you can see here, we have this gigantic apple that's falling from this tree, and we're hoping that our income is going to be that significant. Now, when we look at the agents of production, we know that the value of each of the agents is proportional to that part of the total income that it contributes. All production is going to stem from the use of labor, capital, management, and land. And we also know, given the previous slide, that the agents of production are always paid first, and whatever is left over is going to be our income. The principle of contribution relates directly to the 4 agents of production. The 4 agents of production are proportional to that part of the total income to which they each contribute. Now, residual capitalization techniques apply this principle by isolating the income attributable to a specific portion, for example, land, the building, or even the equity investment, and then you're capitalizing that income into an estimate of value for that specific portion of the property. Highest and best use. So the highest and best use of a property is going to be the use that is going to produce the greatest income or the greatest return to the land. So whenever you are appraising a property, you're always asking that question: is this the highest and best use? Is this the utmost potential that this property could possibly achieve? As an appraiser, how do you select a capitalization rate? The capitalization rate is the link between an income estimate and a value estimate. So choosing the best rate is the critical part of the income approach. Appraisers are going to use interest or overall rate the most. So it's the very first 2 that we have listed here. We have interest rate. It can also be referred to as return on capital, yield rate, or discount rate. And then we have our overall rate, which is the ratio between the income and the value. This is always calculated as an annual rate. So the overall rate really is the examples that we've been doing in class. We then have recapture rates, the return of the capital. We have recapture, we have amortization. This is usually calculated annually. It's not often used by appraisers though. And then we also have the composite capitalization rate. This is a rate that's composed of interest and recapture rates. It's a combination, but appraisers typically don't use that either. Here we have 2 different methods of estimating rates. The first one is direct comparison, which is the formula that we talked about in Chapter 13. Income over rate and value. And then we also have band of investment. Here we have the band of investment method. We know that real estate is made up of equity investors and also lenders. So this method combines the returns of each to produce a capitalization rate for the property that is a weighted average. So this is a method of developing a discounted rate based on the rate of the mortgage interest available, the rate of the return required on the equity, and also the debt and the equity share in the property. So a variation of this method is used to complete an overall capitalization rate. So in this example we have here, the lender's rate of return is 9% at 75% of the property's value. The investor's rate of return is 12% at 25% of the property value. And that equals a property interest rate in percent at 9.75%. Now, how do we get our capital back, right? How do we provide capital recovery? So there's several different methods that are listed here. We have the straight line method. This assumes annual equal recapture from net income. This is used in several capitalization methods. It's very common. We then have the sinking fund method. This assumes safe earnings. It's not commonly used in appraisal. This is where you have investment recapture amounts that are put into a sinking fund or a savings account where they earn interest at a very safe rate. And then we have the annuity method or the Inwood method. This provides capital recovery in the same way as loan amortization does. So it assumes recapture amounts earn interest, and this is also referred to as yield capitalization. So remember when we talked about the 2 different types, direct capitalization for 1 year, which is basically straight line. And then we also have the yield capitalization, which is for the entire time that you intend to hold the asset. Well, in situations where you have an appraiser who is appraising properties with long-term leases, that is when the annuity method would be used by an appraiser. Here we have different techniques, different formulas for figuring out the value of specific components of the property. So sometimes we're trying to figure out the land value. Sometimes we're trying to figure out the building value. Okay? Sometimes we're trying to figure out the property value as a whole, the equity residual. So there's formulas for each type of these, and we're going to go through each one. The first one here is building residual. So the first question is, what is residual, right? Residual is whatever is left over. So if we know that the residual is whatever is left over, then we can use this particular formula to capitalize income when the building value is uncertain, but there is a very reliable estimate of the land. So let's say that we have a sale price of a particular property. We know exactly how much the land is worth, so we subtract the value of the land from the sale price. What is left over is going to be the value of the building. I have an example of a building residual technique, so you can take a look at this on your own. I'm not going to ask you guys to work out any formulas like this for building residual or land residual. I just want you to really have a good idea of exactly what it is. The land residual technique is going to be useful when the building value can be reliably estimated, but the land value is unclear. So there again, we have a sale price. We know exactly how much the building is worth. So if we subtract the worth of the building from the sale price, whatever is left over, the residual, is the value that we would attribute to land. Remember when we initially looked at the income approach in Chapter 13, and I told you it's all about the property itself. We're trying to figure out what the potential net operating income is of the property. So we are not considering how much the investor has put into the property. We're not considering the investor's mortgage payment, the interest that they have to pay on their loans. We're not considering any of that, right? Okay. With equity residual technique, however, you are now considering what the investor has put into the property. This considers what the investor has invested into the property as a whole. So the equity residual technique analyzes the cash flow from the investment. It analyzes the net income after the debt service rather than just the total operating income. So here we are estimating, measuring, and discounting cash flows. So the use of cash flows in appraisal can be very crucial. There are lots of different types of properties that have different types of cash flow. You can have a very even cash flow. If it's an apartment complex, it should be a very even cash flow. You can have a very uneven cash flow. If it's a retail store, or say for instance a car wash. My dad and I used to have a car wash in Swainsboro. The cash flow was very uneven. There were specific months where it was super, super busy, and then there were other months that it was really, really dead. In fact, it's interesting because the months that start with the letter J are the slowest months for a car wash. So if you think about that, that's January, June, and July. I get January because it's cold, right? But June and July, really? And I didn't really believe that when we were told that as we were doing our research and we were first starting the car wash. But once we opened up and we had a full year to look to see exactly what the cash flow was, absolutely that was the truth. In January, it was very, very slow. And then in June and July, it was also very slow. I think because it's warm, people get out and they wash their car in their yard or things like that. So it depends on the type of property that you're talking about, what kind of cash flow you're going to see. Now keep in mind, the analysis of future cash flow really lies at the heart of income producing properties. The investment of income producing properties, that's really what you care about. So whether you're appraising it or thinking of investing in it or managing it, whatever it might be, that truly, the cash flow is really what matters. So you can omit this slide because we're not going to actually talk about discounting cash flows. We're going to stop here when it comes to income approach and move on. So that is chapter 14. Income capitalization is the process of translating income into value. So we're going to select capitalization rates that reflect the type and amount of return that we're looking for in our real estate investment, and the appraiser completes that link between the income and the value. The market value of amounts to be received in the future must also be reduced or discounted to their present values in some way to recognize the time value of money.